Liz Ann Sonders, Chief Investment Strategist, Schwab Center for Financial Research, and Nate Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research. Liz Ann, great to see you. I'm glad you're here. We've kicked off earnings season. What's your takeaway thus far? I know it's very early, but we did hear from at least some of the banks. Any takeaways thus far as we kick off a new week?
It is early. If you extrapolate based on what has currently been reported, you're in slightly negative territory. But if you do what's called the blended estimate, which combines the consensus estimates for the companies that have yet to report, which is still more than 90% of the S&P, you're looking at about a 4% growth rate. But that has been coming down, and I think that's probably more important than things like the beat rate is the fact that estimates have been coming down for the fourth quarter, which is the current reporting season, but also for all 4 quarters in 2024. So as has been the case in recent earnings season, I think the outlook part of these earnings calls is arguably more important than what just is reported for the fourth quarter.
For sure. I couldn't agree more. I mean, I think that guidance is what everybody is always honing in on, Liz Ann. That being said, Nate, I was curious. I know you're watching the range on the S&P 500. Today, we've had interesting moves where we see the dollar moving to the 2-month highs against the yuan, where we're seeing yields moving higher as well off of Friday. So what is your big picture on the range of the S&P 500? Any thoughts on where it may be headed?
Sure. Well, today, like you said, rates. I mean, the 10-year is closing at a 1-month high right now, so that's certainly the culprit. Thank you, Christopher Waller, for helping out with that. Technically, the S&P has been, at best, if you're bullish, you can say it's been going between 4,700, 4,800 over the past month. If you're looking at something like the small caps, they've kind of rolled over. Russell, maybe unsurprisingly, with the 10-year at a 1-month closing high, Russell at a 1-month closing low. So that one's rolling over a little bit. There have been negative divergences in the RSI. I have kind of pointed that out in the past. And from here, with a 19.5 forward PE on the S&P 500, I'm wondering what that catalyst is. And I believe it's got to be in the form of economic data and earnings outlook, as Liz Ann said, because the bullish thesis that's essentially been priced in right here, right now, it feels like in terms of the next catalyst is probably skewed to something that is counter to that thesis, which potentially gives us some downside risk. In regards to the S&P 500, that 48.96 on a closing basis or 48.18 on an intraday basis, all-time closing high. Look how gun-shy it's been as it's gone up to that level multiple times over the past month. I just don't think right here, right now, we have the impetus to push through that, but we do have earnings in front of us. Let's see how that goes.
Yeah, and I mean, Christopher Waller of the Fed actually saying moving carefully, watching those rate cuts, being very methodical about this. No reason to move as quickly. Also, Liz Ann, as we saw the 2-year, the 10-year, the 30-year, all those yields moving to 1 or 2-month highs, those big jumps that we saw today. The question now becomes what happens next, because the central bank officials are basically pushing back on some of those ideas of the cuts. You were noting the March likelihood of a rate cut. Do you think that's still too high? Because there's still a lot of folks betting on a cut even in March.
Given what we know now in terms of the inflation backdrop with the recent reports that have come in, CPI, PPI, soon to be PCE, the other mandate, the labor market data, I don't think all else equal, it's supportive of such a high probability of rate cuts starting in March. And I think that's what various Fed officials are starting to push back on. So I do think that expectations around Fed policy will continue to be a short-term market mover. But really what's in the driver's seat, as we've all three touched on, is the moves in yields. And it's had this direct relationship to what the S&P has done, with the significant move up in yields from late July to late October being accompanied by a 10% correction in the case of the S&P, even more, about 12% in the case of the NASDAQ. Then we saw that yield retreat. You saw the move back up in the market. You saw small caps catch a bid on that lower yields backdrop. And in the past month or so, when we've seen that move back up in yields, it's been commensurate with some weakness in the market. So that's been the name of the game since at least the midpoint of last year. And I think that continues to be what defines at least the early part of this year.
And you know, both of you, Liz Ann and Nate, have noted the Empire manufacturing number here in New York. It's something I've always liked to watch very closely on that index. And when it dropped to this level of 43.7, the lowest since May of 2020, in fact, it's the second lowest print ever. It just shows declines in new orders. And I know, Liz Ann, you had said you were just not seeing the cooperation with some of the other prints. Nate, what were your thoughts when you see something like this? Because sometimes it could be a one-off. I mean, we need to see some consistency. Is that right?
Yeah, and I think Liz Ann can probably comment on this better in regards to manufacturing. I mean, but there's been just, if you look at some of these indicators, and whether it's leading economic indicators, whether it's the inverted bond yield curve, and then you look at some of the other data points within services that look, healthier, so to speak. I think we just have to respect that this environment is a bit of a mixed bag in terms of the economic data. And so, can we pull through this without going into a recession? Certainly that's a possibility. But again, it's going to be good news is good news. The market would rather have one rate cut and a healthy economy than 8 rate cuts and economic data that is contracting. So it's going to be about the data. It's going to be about earnings.
Yeah. And Liz Ann, I mean, I'd love your thoughts on the Empire manufacturing number, but also you noted the trio and people just running to that defensive play of tech and the other names, the other groups within that trio. Final thoughts, Liz Ann?
Yeah, well, as Nate pointed out, manufacturing has been the significant soft spot. That's where you've had recessions on the manufacturing side, and that's why things like the leading economic index have been much weaker than what is borne out in the economy because services has been so much stronger. That's just the nature of this cycle where we saw the compression in manufacturing first. We haven't yet seen it in services, and that has offset that weakness in manufacturing like we saw with Empire today.
Yeah, it's wonderful to see you both. We haven't had a chance to chat. Wishing you both a happy, healthy new year. Liz Ann Sonders, Nate Peterson, Schwab Center for Financial Research. Thank you.